Welcome to the 10 Mil Club Standard Portfolio Meeting for the first week of July 2026.
From Nashville,
It's the 10 Mil Club. It's the 10 Mil Club.
The 10 Mil Club is a an informal group of people who believe that if we could get to $10 million of net wealth, we'd have the financial freedom we're really looking for. The market right now is kind of a placid looking market. This is the percent of S&P 500 companies trading above their 200-day simple moving average, and the 200-day simple moving average, and this is 2 years of it. We're pretty high. We're at about 64, almost 65%. If you're a market skeptic, as it's probably healthy to be to a certain point, this kind of looks like a spot where a reversion to the mean might be coming. This is the percent of S&P 500 companies trading above their 50-day moving average instead of the 200. Also very high, probably got a little room to move upward. But this is the VIX. VIX, this is 2 years of it. Let's back up. Let's go more than like 6 months. So a VIX above 20 is considered an alarm. A VIX below 16 is really considered a fairly placid market. This is a 15.03 VIX. VIX being volatility of Standard & Poor's 500 futures. This is a market that is really not showing a whole lot of concern. The VIX for the bond market, we would look to it. Let's see, the MOVE index is in here. I can just zero in on it. There we are. The MOVE index is kind of the volatility index for bonds, or the VIX for bonds. You would usually expect to see the MOVE index move up earlier than the VIX, and that would be kind of an early warning of alarms. It's not showing any kind of concern at all. So it's a fairly placid looking market, and there's just, we have several symbols we want to go over here, and you'll notice probably with the portfolio and the watch list here, there's quite a bit of overhauling this week. A lot of that is because of rotating that's going on underneath the market. We're kind of seeing a rotation somewhat out of higher risk tech and somewhat into more defensive names. We're not going whole hog into defensive names, but we certainly are taking a look at some things that have a bit more value to them than possibly we have in the past. So with that, let's get to it.
The 10 Mil Club.
A lot of our members really like to see us run through the list alphabetically, so that's what we're going to do. Starting at the top, we don't own any ABM at the moment, and I'm going to look at more of a year of ABM. So ABM has this is a let's go 2 years, I'm sorry, not 2 months, 2 years of ABM. All right, ABM has had a downtrend for a very long time, and then ABM takes this leap on the last earnings and holds this area. Truth be told, if we're really serious about ABM, and we are technical analysts, which we like to believe we are, we probably are waiting out this triangle here and trying to see what ABM is really going to do. So that's our watch this week on ABM. Amazon's new on the list. If you look at 2 years of Amazon right here, you can see the DI plus cross over the DI minus. Down here, DI plus is 26, DI minus is 17.9, and the RSI has been moving up a little bit lately, and Amazon still has an uptrend in place. So with this little move right here, Amazon might actually, if I might, we actually took Walmart off the list. Walmart looks like this. Walmart's actually, at the moment, not great of a chart. We got burned on Walmart a couple of times right through here and just could not seem to make Walmart work. And so with that, Amazon's on the list. kind of paying attention to Amazon. In all honesty, looking at 6 months of Amazon, we're right at the 21-day moving average. We're above it now, having crossed it. The 21-day is below the 50-day, but the upper momentum is still in place. So maybe looking at some Amazon here in the next little bit. Atmos Energy, ATO. Now, all of these have passed my fundamental screen so that the rest of the group can kind of look at them from a technical standpoint. Atmos, I really do not like Atmos's share dilution. However, they make so much money over time that they have a tendency to be accretive in that share dilution. So not much you can do about that, but this is 2 years of Atmos with that stepwise upward pattern above the 200-day moving average. This is a move down below it and then a move back up to it. So probably going to be watching Atmos over the next little bit to see if Atmos is something that we really kind of would like to get into. AXSM. All right, we own AXSM and we are down 4.45%. A lot of that is attributable to this one day on Friday. There is absolutely no news that I can find. Now, we don't subscribe to Bloomberg, but you would think that even if Bloomberg had reported some kind of negative news on AXSM, we would know about it. Didn't stop us out, but that one day, that Friday was kind of you can see this is 6 months of it. There's an up day that big. There's an up day that big. We don't have a lot of down days that big. So we'll have to see kind of what happens with AXSM. But that was a bit surprising. Went into this past week looking at BYRN. Now 6 months is probably, I don't know, I guess 6 months is okay to look at for BYRN. But BYRN, okay. BYRN crossed its line here. And then we were going into earnings, and we thought, okay, well, you know, sorry. We thought let's keep an eye on BYRN. Let's go with 3 months of BYRN here. All right. We were like, well, let's watch it. I'll bet you it's going to sell off just a little bit before earnings. It did. There was the sell-off. And we had an internal conversation, and it was a heart-to-heart internal conversation. Do we buy BYRN now around this high 5, low 6 area? And we just, the CEO of BYRN put out a letter. There's a new CEO. He's been in about 100 days. He wrote a 100-day letter. Here's what we've done. Here's what's happening. We're looking at all of our alternatives, all of that kind of stuff. And we just kind of read into it and thought, okay, if he's having to write a letter like that before earnings, then the earnings, we just read into it. We kind of went, the earnings may not be great. And so we just didn't buy BYRN. And boy, was it a good thing we didn't, because it got killed and we wouldn't have been able to do anything about it. So we weren't in BYRN. You may not see BYRN again next week on this list, just the way it is. Citigroup, we are down just a touch, 0.82%. That's C. Let's look at 1 year here for Citigroup. Not a big concern. Stop is all the way down here at 131.30. Honestly, we are probably doing just fine on Citigroup at the moment, respecting the 21-day moving average. CPB, we have not bought Campbell's yet. Campbell's has been going down for a couple of years and has only just recently now the DI minus closed above the DI plus here, and we don't have an RSI of 50. So we're really kind of sitting around waiting for CPV to show us something. CVS, we own, we're up 2%, 2.03%. So far, so good. We own it. We'll be holding it. Dollar General, we have not bought back in yet. This was a missed opportunity, and this is the difficulty of serving two masters, because we all have day jobs here. We were waiting for a pullback to the 21-day moving average. If you're looking closely, that right there, let me move my comment. That is a move to the 21-day moving average, and we did not buy it in those 2 days. It was just a busy week. If you saw our show last week, we said you probably won't hear from us again until next weekend, and that is the absolute truth. And that's part of the difficulty of serving two masters. So there it is. Duolingo. Now, you can't see this very easy right here. I'm going to go 2 months, 1 hour. We have turned Duolingo into a study of itself. It came down, 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 down. Overnight it crossed. We had the opportunity to buy it in the before market. It leapt, did not to this point. It has simply leapt to this point and then taken on a bunch of volatility up that high. Has not hit a new high, but we're waiting for another turn down here. So what we learned over the past few weeks on Duolingo, if I could just pause for just a second. We are small fry here at the 10 Mil Club, and if you're watching us, you probably are small fry too. I strongly doubt anybody with $100 million to move around in the stock market is watching us out there. And if you are, we'd love to hear from you. But we learned on this and on some other things lately that yes, we probably need to go ahead and buy it in the pre-market. If it crosses the line overnight and gives us and has everything else in place, the uptrend that we're looking for, the turn, the fundamentals we're looking for, the narrative, Duolingo has all of that. But this turn right here, which at Duolingo, let me just go to say 6 months here. Okay, Duolingo has a historical volatility of 65%. That's not the highest out there, but it is not 35%. It is not low. And so you kind of have to nail the entry point on Duolingo, and that is why we were totally willing here in our group to simply miss out on it and look back. It was a conscious decision to miss out on it, look back and know what we did, what we missed out on, because we were just trying to nail the entry. The next time we have something that looks like this, we will buy it in the aftermarket. We haven't done a lot of that. That just hasn't been our MO to this point. But now we know the way for us to take advantage of being small investors is to go ahead and buy something in the pre-market. And you will see us do that over the next little bit. By the way, I'm going to pause here just for a second. If you are watching our video and you like our stuff, we would certainly appreciate a like and would certainly appreciate subscribing to our channel. We do this every week and occasionally put out deep dives on stocks and even do some penny stock coverage from time to time when we get time and feel like it. There is also a 10 Mil Club Facebook group and a 10 Mil Club Facebook page. Every single day, even if nothing happened, we post on the Facebook page and the Facebook group what happened during the day, what we thought about, what we were looking at, what we bought, what we sold, what got stopped out. We will put those links at the bottom of this video once it's uploaded. We would hope that you would join our group, follow our page, but also give us a like and a subscribe along with this video. Moving on, Expedia. We will be watching Expedia. Expedia fits the technicals we like. 62 RSI. The DIs are positioned correctly. We like the lift. We like the 50-day is still below the 200-day here, but we like the lift and the fact that it's on the way up, and the fundamentals look pretty good. And so, Expedia will be watching. GILD just recently crossed over here. It has a pretty nice fundamental scan, GILD does, and it hits some technicals that we really like right through here. So we're kind of, this turn and touch, we'll be watching for some sort of continuation out of that. GIS is General Mills. General Mills has been going down for a long time. I think I'm going to pull up 5 years of General Mills here. And with good reason, General Mills has been going down a long time. General Mills, if you look at it, it has decreasing revenue, and it's because there's been this whole movement to more natural colorings, natural flavorings, and the world has kind of moved away from a lot of their products, and there's some discussion out there that General Mills' offering has gotten a little bit stale, no pun intended. You can always set this line. We know these lines are arbitrary, but General Mills has taken a bit of a turn down here. And if we go with 6 months, so General Mills, RSI let off a little bit, kind of around in here. But if this upward momentum establishes, there is a movement a rotation going on right now of money rotating out of tech and AI and that sort of stuff, and largely into, I mean, you keep hearing about tech and stuff like that, but there's a lot of money rotating into things that are a bit grumpier and stodgier. For example, we don't actually have this on the list. This is Coca-Cola. Some of the thinking out there is that Coca-Cola probably is going to be a beneficiary of that, and you know, honestly, we probably should put Coca-Cola on the list. So there you go, we have. Moving on to global ship lease, GSL. We own this, and we are up 4.02%. It's been a lackadaisical upward 4.02%, to be honest. But the way things go for us here, and I'm sure you can relate to this if you're a trader out there listening and you have any experience at all, we know that the second we sell that, that is going to go right on up into the 45 range, and we're going to miss out. So with the technicals in place, you can see this is a year we're looking at here. Let's actually go with 6 months because it gives the same technicals. We've got the DI plus where we want it. We have the RSI where we want it. We're okay with an RSI pointing the wrong direction as long as we still have the upward momentum in place. We're pretty far up above the stop, maybe moving the stop up this week. Of course, we'll let you know on the Facebook page when we do. But global ship lease, we still own. Robinhood, okay, Robinhood has a historical volatility. If you look at this middle one right here, Robinhood has a historical volatility of about 66%. That is pretty high. It's not 85%. Like I believe it was, who was it we were looking at that had a really super high? Anyway, Robinhood is not a low volatility stock by any manner or means. But we do have a trend here in place, and we will be watching. That's a regression line right there, and we are below the regression line right up in here. So there's the 21-day moving average. We're respecting it at pretty much every turn. So if I can convince the crew to take a shot on Robinhood, and if we can find the perfect entry, because we need one of these, and we may be in the middle of one of these right now, to pick up Robinhood, we probably will. HP, we own. We bought fairly recently. I believe we've actually owned it. Well, that kind of indicates that we bought it earlier this week. We're down 0.08%. Not a whole lot. So at the moment, everything's in place for us to continue with HPQ. So we're okay. Had this run up here, and then a throwback, but a throwback to a higher low, which was a higher low, which was a higher low, which was also a higher low. So we saw this rotation and thought, you know what, we're going to buy it right in there. And so far, once we came out of that, we've done okay. I mean, we've survived the better part of a week. So a lot of times just surviving. Coca-Cola just put it on there. El Pollo Loco probably will be buying this week. Loco. So that's the 21-day moving average. It hit it, bounced off. We will probably be buying Loco this week. Lazy Boy, LZB. Now, Lazy Boy's stock went down for a long period of time. If we look at 2 years like this, you can totally see Lazy Boy's stock go down for the better part of a year. It'll leap and stuff. They do a lot of really great capital management. They actually recently sold off a part of their company and then bought a bunch of their stores, their franchise stores, I believe. And if I'm wrong on that, forgive me. But with higher interest rates, so a lot of people will buy, like I actually own a Lazy Boy couch. They're expensive couches, they're expensive chairs, they're expensive things, but they're very nice couches and very nice chairs. And Lazy Boy has declining revenue in the post-interest rate raise era. I don't want to call it the high interest rate era because it's not. These are actually fairly normal interest rates, actually. They may even be a little bit low, but they're higher than they were, is all. And so they have been able to have people have bought less Lazy Boy products through financing, because a lot of people don't have $4,500 for a really nice Lazy Boy couch. They are nice couches. My couch, that's a Lazy Boy couch, which I, by the way, did not buy new. I bought it used for a whole lot less than $4,500. But, and spent a whole day steam cleaning the thing so it quit smelling like dog. So there you go. Always looking for a deal here. Great couch, expensive couch, but to buy a new one, you're probably going to have to finance it, because most people don't have $4,500 laying around. And so Lazy Boy has lower revenues, but they manage their capital stack very, very well. Share count, share buybacks, low debt, high interest rate, higher interest coverage. They just look really, really good. I don't know how far this rise might go, so there's a bit of danger in buying Lazy Boy right now. We don't do a lot of watching stocks that are $800 a share. McKesson, however, is $800 a share, and if you look at the fundamental scan, there's a reason that McKesson has risen over the last 2 years from this $460 range all the way up to $800. They manage their capital stack very well, and they have an industry that gives them a lot of cash and income to do so. So with this shift right here, we are now watching McKesson. It's probably the only $800 stock we're really going to watch. Medtronic we picked up a little while, a couple of weeks ago, I guess. I'll go to 1 year here. Medtronic's technicals are beginning to line up. That's 59.9693. Looking for a 60 RSI. We're almost there. You can see the beginning of the up move. So Medtronic may actually be one that we look to pick up here pretty quick. NEXN's been on the list. NEXN waiting for a pullback to this 21-day moving average. When it does, we will probably go long NEXN. NWN, Northwest Natural Gas Holdings. This one is a natural gas distributor. And if we go to the 2 years here, you can see NEXN. You need a good entry point on NEXN, but right now it's respecting its 200-day moving average. I believe if I calculated before the show, I went, okay, from 50, 40, going up 25%, because that's kind of our desired return. You got to be $63 a share. That's way up there. This is 58, 59. It would take quite a bit to get Northwest Natural Gas there, but it could probably do it over a year's time. If it got high enough, you'd want to go ahead and cash out, but it'll pay you while you do it. And so it's not such a bad thing to have at the right entry. We may be picking that up. New one, OSG, Octave Specialty Group. This company restructured to become a pure property and casualty insurance company. And it looks like the market is now beginning to reward that. So this turn right around in here, the technicals are starting to line up. Yes, the RSI is at 51, down from this 69 and 65 area where it was, but it has to be in order to throw back to the 21-day moving average. So we will probably be paying a lot of attention to OSG this week. QLYS I only have here because we sold out of it into strengths. I'm just going to, this probably won't be here next week. This is a software company. It's a cybersecurity software company. We sell it here. It does rise another $20 plus, but it just got so volatile that we thought, you know what, that can go down just as easily as it can go up, and it appears to be anything from holding to just kind of really working it right here. We don't know what's going to happen. It probably will come off the list next week because there's just there are other things to watch, and we don't need to do that. We made, well, from 109.21 to 141, that holding period return was 29%, and it only took us less than a month to do it. So that one we kind of caught lightning in a bottle, and when you catch lightning in a bottle, you kind of need to close the bottle and sell the bottle. So that's what we did. SCI, we are up 4.52%. This is a very valuable company. We've talked about this one. SCI is a death care company. It's as boring as a company and a stock can get. But with the rotation into boring, valuable things like this, it is highly likely that this will be $85 a share and you'll get paid along the way. We got stopped out on it over here, then bought it again, and since then we're up 4.52%. So far so good on SCI. Feeling pretty good. These two, SH is actually a short S&P 500. We are waiting for trouble in the market. We don't need this week. Do not go buying SH. PSQ is actually the short QQQ. Also not seeing problems yet. So we just keep them on tap for the day that we actually need it when the market comes unraveled. That day was not this past week. And with the VIX and the MOVE index doing what it is, it's not really showing that we even need those over the next week. So TMC, the metals company, is all the way down in the 421. It has been as low as 384 area, the $4 area. We talk extensively about this only because people want us to, because it's our mascot stock. We are the 10 mil club, and that is TMC, the metal company. Don't go buying that. TREX, the plastic lumber company, if we're looking at more than 6 months, let's look at 2 years here. So TREX goes down, 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 and naturally so. If interest rates are higher than they were, it's tougher to buy a home. That's the narrative, and the stock goes down. But lately, we have an uptrend in place past a few earnings, and then we cross the trend line. Now, just so you know, trend lines are really almost fake technical analysis. I put them there because it gives me something to relate to, but really what we're more interested in are moving averages and things that and honestly, if we're looking closely at TREX, the technicals are only so good, but with enough of a showing, we could see TREX actually being accumulated. And that is what we think of it. So, placid market, not showing a whole lot of trouble. There are some opportunities out here. We're not equally interested in all of those, but they're here specifically because all of them show us some of the technicals we're really looking for. Would love to hear from you. If you want to comment below, please do give us a like on the video. It helps us a whole lot. And from all of us at the 10 Mil Club production room and our singers, the 10 Mil Club singers, Sophie, Hannah, and Presley, and Jackson, our announcer, we will see you next time on the
10